Hi, my name is Randy Smallwood. I'm President, Chief Executive Officer of Wheaton Precious Metals. I'm also the Chair of the World Gold Council, and so pleased to be here today to tell you a little bit about Wheaton Precious Metals. We created the streaming business model close to 20 years ago. 2024 will be our 20th year, so we've got 19 years of history as an alternative form of finance in terms of investing into the mining space, and what we actually deliver to our shareholders is very profitable precious metals production that has fixed costs, and so very little cost risk. And so it's incredibly attractive, low risk way to invest into the mining industry, and for us, the precious metals industry. So looking forward to this.
Randy, good to see you. Welcome to London.
Matt, always a pleasure.
I say welcome to London. You've been on kind of world tour for the last 3 weeks. How's it going?
Love it. I actually own in London now, so I've even got a place to stay over here whenever I come over now.
Very good.
Yeah.
And so you're obviously on the road meeting institutional investors and telling a story. What's the feedback been? What's the pushback been?
Well, there's elevated interest in gold. As I look around the world, you can see all sorts of reasons as to why we've got elevated interest in gold. And we are seeing that at the institutional level. When we go into the fund managers, I have to say, for the last couple of years, COVID kind of messed with that, but we haven't seen the same level of interest as we have here recently. We've seen a pickup. We're starting to see 4 or 5, 6 people at the meetings versus the 1 or 2 gold believers that have always been present at pretty well every investment fund out there. So we are seeing elevated interest, a big appetite. We've had full days of meetings, multiple days. I think we've hit about 7 different cities across the continent of Europe, and now here this is day number 4 in London over the last 3 weeks.
Right. So you're going to hit that with all the reasons to believe why there's still growth in this story. $20 billion company is something else, but it gets harder and harder to keep that growth profile, right? So what are the kind of factors that you point to those fund managers said, look, we're still a growth story. There's a long ways to go, and what's the feedback been on that?
Well, we're at an incredibly exciting time for wheat. This year, we produce about 630,000 gold equivalent ounces. Our current portfolio, organically, within the next 5 years, by 2027, we'll be at 970,000 gold equivalent ounces. So we have 50% growth. For a company, $20 billion market cap, to have a 50% growth profile in the industry, there's no companies like it in the space, in the precious metal space, in the mining space as a whole. To have that kind of an elevated, that size of a company, and that strong of a growth profile. So it's probably the company I would say is not only the strongest it's ever been, but I am the most excited about what we have in our near-term future, just in terms of some of the investments. We've been very busy making acquisitions in the last couple of years, we made 10 acquisitions over the last 2.5 years. And that's all, along with organic growth at our existing asset base, that's all going to deliver 50% growth over the next 5 years.
Right. So let's look at the organic components and where the bulk of that revenue, because you've got a couple of big projects in there, North American, South American focus predominantly, not exclusively. Tell us about that kind of that breakdown that of the different investments you have made there.
Yeah, sure. Salobo, of course, it's owned by Vale. It's one of the richest copper mines in the world, but it also produces a very healthy byproduct, non-core byproduct in gold. And so we have a streaming contract where we get 75% of whatever gold is produced at Salobo on a go-forward basis. And it's, it delivers on the order of 200 to 300,000 ounces a year. Well, what's particularly exciting is that they're just starting up their 3rd phase this year. They turned on the switches on a 50% increase in throughput capacity. And so we're going to see definite growth from Salobo as it goes forward over the next few years as they ramp up line 3, their 3rd phase, 3rd expansion, and start increasing their own metal production going forward. And so we're going to see a definite uptick there. But even beyond Salobo, the Peñasquito mine in Mexico, owned and operated by Newmont, the Antamina mine in Peru, owned and operated by a conglomerate of companies, but Glencore's in there. We get silver from Glencore's interest in the Antamina mine. All of these mines have growth in terms of either higher grades coming in their mine plan going forward, or shifts in terms of the mine plan moving in-pit crushers to access higher grade material. And so, 2/3 of that growth is actually coming from existing operations as they ramp up their production levels through expansions or grade scheduling and such. And then the other 1/3 is coming from what we call greenfields assets, which is new mine construction. We've got the Blackwater project in British Columbia, that's moving into construction. It's well into construction already. We've started funding that. And we've also got the Goose project up in northern Canada, in Nunavut, in northern Canada. The B2 Gold is building, and we're co-funding on that. So again, very exciting times.
Exciting times for sure, but it's sort of uncertain times as well in the marketplace. And there's opportunities and there are threats in there. And I'm intrigued as to how you and the board think about that and taking advantage of this situation. You're sitting on big cash reserves at the moment. You paid down, well, I don't any debt?
No doubt at all. We haven't had this now. We haven't had debt for a year and a half now. We're generating close to $1 billion a year in cash flow.
Yeah.
And in fact, with this growth, we'll be climbing over $1 billion a year of free cash flow. My biggest challenge is how do we keep on putting the money back into the ground effectively and accretive? And that's one of the key things, accretively. There's lots of opportunities to invest in the mining space. The challenge is picking the right ones and avoiding the wrong ones. And so, Wheaton, we have a reputation. It helps that my background, I'm a geological engineer. So I come from the technical side, so I understand how important that is, that we focus on good quality assets. And so we've got 93% of our current production comes from the bottom half of the respective cost curve. And that's the most important metric in our eyes in terms of is a mine investable or is it not? How profitable is that mine to the operating company? If we're not the operator, we're only 41 people in our company, $20 billion company with only 41 employees. We don't operate the mines. So we have to rely on these mines being very profitable for the operators so that we will get our share of the metal as that metal's getting produced.
Right. So let's look at that kind of blended portfolio of yours. You talked about, being in the bottom
two quartiles. So the bottom half of those respective cost curves, yeah.
Which is great. And that's coming from, a handful of projects of yours. Is that right?
Well, so let me elaborate on that a bit in this case. So we get gold from copper mines. We get silver from lead, zinc, blocks. We get gold from nickel. Yeah, so we're purchasing non-core byproducts from these base metal mines. So when I'm looking at a copper mine, one of the most important criteria is where does that copper mine fit for the operator in the worldwide copper cost? So we're looking at the entire world of copper production. We want to make sure that that mine is one of the most profitable of the copper mines out there. So our focus is the bottom half of that respective copper cost curve. Even though we're not getting copper, we're getting gold as a byproduct from that copper mine. What's important to us is that the operator is very profitable of its mine, because if he's profitable, he's going to continue to reinvest into that mine. He's going to focus on exploration. He's going to focus on expansions, and that's the key thing. So for us, we have 19 mines that are delivering us metal right now. We have another 15 development projects at various stages in terms of going forward. And for us to have 92% of that production, again, I would argue it's probably the strongest portfolio of mining assets in the entire mining space.
Right, you talk about being a geologist helping you sort of look at, analyze and understand some of these projects. Right. I say companies as a whole, but projects. You do streams on projects specifically. Is that right?
Yeah.
Right. Okay. So that's helpful. But we've seen a very different market over the past 3 years. We've seen kind of COVID hit costs. We've seen inflation go through the roof, and we see it still sticking with us on several.
Great times to be in the gold industry. It's anytime it's bad, it's good to be in the gold industry.
It is. We'll come to that. I want to talk about that. But I'm saying, but has that changed your thinking in terms of, you talk about bottom half type cost curve projects. Brilliant. Because there are also marginal projects out there looking for alternative financing. Clearly, it would be tempting to kind of leap in there and take a chunk of that, but you're less certain these days, it would seem, of their ability to even get through the kind of capital raising phase, right? And get into production and be able to do it with the margins that they perhaps would have 3 years ago. Right. So gold's gone on tear. It's interesting. 2000 or nearest down at 2000, say 1950. I would have taken that every day of the week 3 years ago. But now, I'm looking to 2, 3, 2, 4 type levels to be as attractive as that kind of 2000 level back 3 years ago. How are you viewing things?
Well, it requires focusing on making sure that the assets have strength, and so we've never changed our standards in terms of what we've invested into. That's how we've had the success we've had. We started this company, as I said, 19 years ago, and we've always had a focus on quality, and so that hasn't changed. Now, what I will say is that the streaming as a source of financing has dramatically grown. And so as we've had success, of course, that's brought in competition, but it's also dramatically increased the number of companies out there that are looking at streaming as a source of equity capital to help them fund their growth on a go-forward basis. Well, and so we've never had more companies in the queue waiting for streams coming forward. We got 17 assets that we're looking at right now as potential future partners in terms of going forward, that we're going through the technical due diligence and the project due diligence to make sure it's so I think that's what's happened in the last 3 years, is that the markets aren't supporting, especially the mid-tier and smaller mining companies out there. Not a lot of equity support. The shares aren't performing well. And so what that does is gives us an opportunity to come in and provide a much more attractive source of capital for these companies. Right. We're busy.
I bet you are. You know, you mentioned this of 2004 coming up with, I think it was Wheaton River and then Silver doing their thing. So that was new then. That was innovative then. Streaming is now kind of mainstream, but it still isn't a big chunk of the kind of equity debt portion of the way that companies look to raise money. Why should they? What are the advantages to the company of doing streaming, for instance? Not say keep royalties separate.
Well, if you're a copper mining company, like we've had numerous contracts with Glencore. Nobody invests in Glencore for their byproduct silver production or gold production. There are 3 contracts with Vale out of Brazil. Nobody buys Vale because they're interested in the gold production from their copper mines or their nickel mines or in cobalt. That's not what we invest in the Vale for. So those are non-core assets. That byproduct metal that comes out of these copper mines, nickel mines, lead zinc mines, that's non-core. It's a non-core asset. And so any company, when it needs to raise, if it doesn't need to raise capital, it doesn't need to talk to us. But if it needs to raise capital, if it needs access to capital to fund its growth, one of the first things they should do is look at their existing portfolio and say, is there anything non-core here that we can crystallize the value of, and so we can focus back into our core franchise? And so that's the whole concept. Glencore, one of the largest companies in the world, multiple streams, Glencore. Vale, one of the largest companies in the world, but because the gold isn't important to them. And so when it is important to us, it's important to our shareholders. And one of the beauties of the streaming model is that the correlation, the connection between gold and copper in a copper mine, the connection between silver and lead zinc in a lead zinc mine is very strong. So we don't have to be there as operators, because we know that as they mine the copper and the lead and the zinc and the nickel, they'll also be mining the precious metals. It comes out in the equation at a wash. And so the risk from our perspective is very low, because we know that they're going to be motivated to produce as much copper as they can on a go-forward basis, and we get the benefit of that.
Right. Explain why people like Vale and Glencore, who have decent balance sheets and can raise cheap capital if they want to, or indeed, are sitting on a bunch of cash as well, would come to you. Like, because they kind of, I get with some companies who are a little cash constrained, they kind of dilutory story.
Yeah.
But for big companies like that, why go with you?
Well, and then we haven't seen anything from them for a long time now. It's probably been 5 or 6 years since we've done anything with those big companies, mainly because they now have very strong balance sheets, but they haven't always had strong balance sheets. Yeah, so you have to have a company that's got capacity to act when the moment is at the right moment. And that's what I think we had. Was from 2013 to 2018, there was a whole bunch of over-leveraged companies that had too much debt, and they needed to get it off their books. And that's when they did sell off non-core assets to the streaming companies. And so that's where we got access to those contracts. If a company has strong internal cash flow, it really doesn't need the outside capital to fund its growth. It just reinvests that internal cash flow. So that's why currently, if you look at the last 2.5 years, the 10 deals that we've done in the last 2.5 years, they're all mid-tier and junior companies. A lot of them single asset companies. They've only got one asset they're building going forward. So they don't have the same access to that operating cash flow. We don't usually compete against debt. What we compete against is the equity piece.
Yeah.
You can never fund it entirely from a bank. A bank will want an equity contribution. In terms of any capital going in, the lenders will always want an equity contribution. The equity contribution usually has to come from either issuing shares or streaming. Currently, streaming is much more attractive as a source of capital. The cost of capital from streaming is way more attractive than issuing shares, mainly because the shares, again, are so depressed right now. The mining industry hasn't it's suffering from very low valuations. And that keeps us very busy. Every time we announce a new deal, we get 5 more companies come through the door wanting to do deals. We kind of sort through them pretty quickly and now down to 1 or 2. But, like I said, right now, we've got 17 different approaches we're looking at various stages of due diligence.
Right. And I guess the killer and the kind of the value destroyer in this sector has traditionally been time.
Yeah.
Right.
Costs and time.
Inevitable.
Yeah.
Costs come with that
Yeah.
time, right?
Yeah.
And the cost of that capital. So for companies, obviously they're very kind of conscious of that. But for you, likewise, if I look again, coming back to this tumultuous time we've all been through, who has affected your thinking and your behaviors and your allocation of capital,
Right.
jurisdictional risk. That's been very, very prevalent in conversations along with ESG and lots of other things,
Right.
because we've seen South America and this kind of social unrest. We've seen countries like Chile going through changes in constitution. We've seen Canada even, just these little friends up north who are struggling with kind of First Nations issues. It takes longer now to get into production. I guess you're conscious of that. Has that affected your deal structure?
Well, typically we don't invest. The bulk of our capital doesn't wait until the permits is received and during the construction, right? And so a lot of our more recent transactions, we do have what we call an early deposit, which is 10 to 15% of the total stream, and we'll push in up front to help them get over that final hurdle to get that permit in place. And yes, we have that. Time is one of the biggest challenges we have. It takes longer to get permits than ever before. But if we choose wisely, that also gives us a great opportunity. And I will tell you that any of the money that we put in as an early deposit, we get a much higher rate of return on that investment than we do in the construction cost, because the risk is higher. And so when we value the original transaction, it'll have a higher discount rate applied to reflect that higher risk and that stuff. So we're well compensated for that risk. And it's only about 10 to 15% of the total stream. And so it opens up a lot of opportunities for us, because that's the point in time that these companies have no access to any other source of capital. They can't access debt. They don't even, because they don't have that permit in place. You won't be able to do that, right? And so we do take a wee bit of permitting risk, but it's not significant in the overall scheme of things. The transaction we announced just 4 weeks ago with Alumina Copper on the Cangrejo project down in Ecuador, $300 million deal. We supply $48 million to help them purchase surface rights and finish off the feasibility study, get the permits in place, and then the remaining $252 million will be drip fed over the construction period going forward. It's a good example of the opportunity we have for us. By 2030, Cangrejo should be delivering 25,000 ounces a year for us. It's the other beauty of us investing into the base metal space. Base metal mines are typically more capital intensive, which means they need much bigger reserve and resource base than a normal precious metals mine. And so we have 60 years of reserves and resources. And what's particularly amazing about that is that earlier this year, we just reached equilibrium. Right. We've invested just over $10 billion into the mining industry. Earlier this year, our cumulative cash flows just surpassed $10 billion. And so we're now net positive, and we still have 60 years of reserves and resources in front of us.
Is that concerning? Is that front end?
Well, reserves in the front end. Yeah, reserves are front end. It has an incline over time. Yeah, sure, exactly. Right. It's the need. It's always only one to go down, but.
Just want to talk about intersectional risk as well. Ian says, so did you guys go over, was it Rio 2?
Yes, that's right.
Right, okay. I mean, just again, does that inform your decision making? Does it, do you factor, I know you said, okay, we factor the risk component in at the front end, so we do okay,
right?
Don't worry about it.
Yeah.
But when moments like that happen where you kind of go,
changing government. It's changing government. City of Two ran out of problem, and it was impacted by COVID.
Yeah.
So the permitting process for Phoenix was delayed. Yeah, and didn't get processed through. And then they had an election. There was a change in government. And the new government that came in rejected 8 out of 10 different applications for mining down in Chile. This is Chile, which is supposed to be one of the friendliest countries to mining. And Chile is the biggest portion of, exactly. And mining is the biggest portion of the GDP in Chile. There's some good wine. That's about it. Maybe a little bit of tourism. But really mining is core to it. So to have a new government come in and reject 8 out of 10 permits, and unfortunately Phoenix was one of them. Yeah. And so we have seen, for now, exactly, right? Now Phoenix is working its way back through the process. A bunch of those permits have since been resubmitted and approved. Phoenix is sure got far off of that. And so we have to continue to push that forward. It was a bit of a shock to Chile. But the fact that the constitutional, the revised constitutional approach was so strongly rejected by the current population, I think is such a strong signal back to the new government that they have to work with industry at a pace.
Yeah, it's mining, right? There are moments like that, but the bumps and stuff.
Best description I've always heard is there's a pendulum, and sometimes it swings to the left and sometimes it swings to the right. And you have to make sure you invest into it. It's one of the key reasons why we look for high margin projects, is because if there's increases in taxes or royalties or fees or stuff like that, we want to make sure that that asset still has the capacity to be profitable for all the stakeholders, even though you've got a government that's zeroing in more taxes. Right. So that's really one of the driving reasons as to why we focus in first and second quartile.
Absolutely. And plus, I just want to say, it's a good project, good CEO. I like that.
Yeah.
Okay, let's talk. I know you're not CFO, but I want to kind of do a few more numbers in this conversation. All right.
As a CEO, I've probably had to look at the occasional financial statement. So,
Well, first of all, in terms of your percentage of the market that you, because I'm looking at this space, like you say, I think Franco went first with their royalty back in 1986. You guys went 2004 with the streaming, and there's been a bunch of people come and go, a few acquisitions last year. So normal, run-of-the-mill stuff.
Right.
But nevertheless, still a small space, and as I mentioned earlier, it's royalties and streaming as a percentage of the total funds raised in mining is still relatively small. So I'm interested in growth. What percentage of the market do you own in the moment in terms of the royalty streaming or streaming as a whole?
Well, you look at it on 2020. Yeah, if you look at market cap, Franco's definitely got a higher market cap than us, but not by much, and we're the second largest. And so I would say if you summed up all the companies, we probably got about, from a market cap perspective, somewhere around 30%, right? 5% of the total, somewhere in that range, maybe even as high as 40. As Franco's 50. So
yeah.
So anyways, in that range, Royal Gold's also another sort of senior player, and there's a whole bunch of juniors out there, right? The juniors don't trade as high because a lot of those deals that they did, they had to modify the structure in order to get their foot in the door. So the market's pretty intelligent in terms of recognizing that their stream is just as good as a good old Wheaton stream, right? Wheaton streams are good and strong, life of mine and exposure, good solid security and references. So yeah, it's that's the space. Now I will point out that those traditional royalty companies like Franco and Royal Gold are now streaming. It's the bulk of their revenue comes from streams, and so that's one of the key things, is that the success of our business model has bred this competition, and in fact, it's converted the royalty companies to streaming companies. So
right, but explain. There's a big audience of sort of not quite as au fait with some of the terminology, right? Say royalties, streams, cash, and physical. So,
yeah, exactly. It's probably the best way to describe it. Royalty is a registration on land. Typically, every jurisdiction is different around the world, but in the general sense, a royalty is just registration on land, which means you don't have a good, strong relationship. It's not a partnership, so to speak. And I came from the operating space. I've built and operated gold mines. I have royalties and those things. And I always hated the phone calls from the royalty guys, because all I wanted was checks, cash, and they'd send in an auditor once a year to make sure that I wasn't messing them around with it, right? It's a painful relationship. Streaming is different. Streaming, especially the way we focus on partnerships, right? And it's nice they want us up front when we deliver that cash up front, but after that, we're getting our metal at a great discount to the swap price. And so we better find a way to sort of add some value to keep that a positive relationship going forward. So a stream is a contractual partnership. It's a relationship, and we get metal delivered to us. And so because we get a share of the metal and it comes in metal form, we get gold and silver credits to it.
Don't get this all into that. I can.
Yeah, well, it's all in the hotel room.
Right.
Oh, hold on. We don't have a hotel here. Yeah. Yeah, no, it's, no, we don't hold gold and silver. When it comes in, we effectively put it back into the market. So what we deliver to our shareholders, our promise to our shareholders, is profitable precious metals production. So we put a lot of focus on that in terms of not folding it, not diversifying. When you invest into Wheaton, what you get is access to profitable precious metals production.
Do you have some flexibility over the contract? You talk about discounts, but you can also do it as a percentage to the spot price on the day,
right?
Presumably.
Yeah, exactly. So that's the other advantage with streams, is that we do have that residual production payment. And the reason we structured that is that when we created this company back in 2004, we recognized that there's always a base cost to producing this non-core byproduct metal, but it's not that high, because generally all the cost is focused on recovering the copper, the lead, zinc, nickel, or if you're getting silver from a gold mine, the gold, right? And the non-core byproducts sort of come along for the ride. And so there's not a lot of direct real cost to producing that. And that's why we have that base production cost, a production gain on a per ounce basis. So, we sign a contract with, give the biggest asset, of course, is Salobo down in Brazil. We get 75% of the gold. So every time Vale sends a shipment of copper concentrates to a copper smelter, they smelt that copper, the gold comes out. If Vale gets 10,000 ounces of gold, they give us 7,500 ounces of gold. And when they give that to us, we pay them $400 and some odd dollars on a per ounce basis going forward. And then we turn around and sell it in the spot market at 2,000. So our margins have consistently been between 70 to 80%. And it's good, strong structure that goes forward. The one thing that makes us a little bit unique in the space is that we put a lot of effort into trying to support. We are co-funding community programs, which royalty companies never did before. We have technical ambassador programs where we supply technical expertise to try and help them. We have this overlying mantra: the stronger our partners are, the stronger we are. And what that does is generates return customers. Out of the last 10 transactions we've done, 7 of them have been with people or companies that we've done previous transactions. Return customers, repeat customers. Our company is a service company. It's not a mining company. We provide a service to the mining industry. We take production risk, but we're a service company. The key holy grail of the service industry is a return customer, a repeat customer. And we're getting repeat customers. And I think that's one of the things that makes Wheaton very unique. We've been busy in this space in the last 2.5 years, 10 transactions. That's more than everyone else in the space combined.
Right. So was straight of all sectors. I think sounds a good point to make. Actually, that enduring relationship.
Yeah.
From a Vale or a Glencore, like you help them get it, right? Let's talk about how, and I do want to come back to the growth. I'm determined to get the growth thing like fully nailed, but just maybe think a little bit there with regards to how people should value. If I'm a charterist, I'm looking at a share price and it's bouncing around. And I always kind of thought royalties, streaming, it's kind of immune from the economy because you've got your margins fixed, obviously relative to what the gold price may be or whatever deal you've structured. You should be kind of immune to the bulk of what's happening out in the economy. But you've had 2013, 14, you, like everyone else, had a little dip there. You're a smaller company then, but admittedly, but now you're a big boy. Yep. Right? You had a little dip in 2022 like everyone else. Yep. Right? Yep. So people aren't valuing you purely on a kind of cash generative basis, clearly, despite you clearing out the balance sheet and doing all that good stuff with acquisitions. So how does it
it's the exposure to precious metals. The fact that we've got 60 years of reserves and resources. And I think when it comes to precious metals and specifically gold, which have the bulk of the value in the precious metal space, step back and look at what it was trading at in the year 2000. What we've seen is over 20 years now, continuous general trend up with a little short-term volatility. You get the occasional war, you get the occasional financial crisis in between. That's always going to be some volatility. But you have to step back and look at it. We've got this consistent uptrend that has been going. We're now talking about, we're near record levels in terms of gold price, but it feels like a foundation, feels like a base. Not a lot of strength below that. This has got strength behind it right now. 10 years ago, we had gold prices this high, and everyone thought, wow, this was a bit frothy. Yeah, right? It didn't last very long. Now we're looking at it as being, near a basement, a solid foundation, and expectations are prices to go much higher. And when you look around the world, it's easy to understand that. It's easy to support that. And so we just see all sorts of opportunity in the space. So investing into us is a great way to not only get exposure to the commodity price, right? Which is, the risk profile kind of fits that. But what we provide is the upside of exploration success, of expansion potential. And so there's 3 factors that will deliver returns for our shareholders. One of the most astounding, little tidbits of information is that our partners have essentially discovered for every ounce we've mined over the last 20 years or 19 years, the exploration has replaced it. So our mines are accurate. And so far they have replaced every ounce that's been mined, or close to replaced every ounce that's ever been mined. And so, if we can keep on being that and delivering that going forward, that's what we're delivering to shareholders. So there's 3 different ways they'll win. Profitable exposure to the commodity price, levered exposure because of our production payment, growth potential of these assets, and both on the exploration side, so longer mine lives, but also expansion potential in terms of moving some of that exploration success forward and growing the lines from a capacity perspective. And so we deliver all of that.
Are you a fan of sticking to your knitting, or do you think that, because if I look at the growth profile, you're North America, South America, you have precious metal byproducts, you know what you're doing.
Yeah.
You've got a couple of assets in Spain, I think, and one of them maybe Finland. But
Portugal. Yeah.
Portugal is it, right?
Yeah.
Is, you can do two things. You can go geographic expansion. Western Australia seems to be quite popular for gold.
Yeah.
You've got and obviously West Africa type stories, or you can branch out into other commodities, other metals. So where are you at? It's like, say, 20 million is a big number.
20 billion.
20 that'd be nice. 20 billion is a big number, but you can do more.
Oh yeah. We're very busy.
So look at those three pillars.
So as the name implies, we're only focused on precious metals, and a lot of our peers have exposure to oil and gas and iron ore and copper. I can understand the copper a bit, but iron ore and oil and gas, it doesn't fit the model. And they kind of talk about the arbitrage of valuation that they deliver, but it's not real value back. Our focus is delivering a clean, pure product to our shareholders. So that is precious metal, profitable precious metals production, high margin, low risk precious metals production. When it comes to diversity, when I hear people argue, diversify and get broader exposure and all that. As soon as I diversify Wheaton, or if I was to go out and explore diversifying, I'm forcing every single one of my shareholders to diversify with me. And I don't really think that's the right thing to do. I think the investor should be determining what kind of an diverse mix of exposure that they want. And so our focus is purely precious metals on a go-forward basis. In terms of jurisdiction, as you can imagine, a 60-year reserve and resource life, political risk is very important to us. We want to be there for these mines for a very long time. There's not a lot of countries in the world that have had stable governments for 60 years, right? And so it is something that is important. Now, there are ways that we can sort of protect ourselves and measure that risk, but the best thing to do is just avoid those kind of jurisdictions and look at places where we have strong, stable environments and confidence in our ability to act. And so, we have looked in Australia. It's a great country. We have looked in Asia. We've looked in Africa. We've put in proposals there. But it's clear that when we value an asset, we factor in all the different risks, including political risk. And it all has an impact on how we value our cost, the expected return we want on this. And it's clear that the way we value political risk makes us uncompetitive compared to our peers. Right. So we're probably a little bit conservative on that front. Right. I'm not unhappy with that. Right. Here's the key thing. We're able to put our money back into the ground to continue growing the company. If we can't, we just increase the dividend. And the dividend has been growing on a very consistent basis in our company and will continue to grow all the time. That's about, the yield is low because our share price is nice and high. It's kind of about 1.5%, and it's 15 cents per share per quarter. And it's, we've had a good, strong, progressive growth in that over the last many, many years. And we'll continue to. We don't. Defensively, about 8 years ago we did, but not a lot. Our preference is to come up with a good, sustainable, consistent dividend. And so that'll be our principal focus.
Okay. Well, look, Randy, good story, man. Really nice to meet you.
Really enjoyed this.
Yeah. We'll see you again and stay in touch, okay?
Fantastic. Sounds good.